Thank you, everyone. This is indeed a very important and significant milestone for all of us here in this room. It's a decade or more of ecosystem building. It's evangelizing a sector which was very new when IISc started, and when some of you started, with the concept and investing in India. For us, it's very important because it's about building a narrative for India as the impact lab of the world. And over the years, transitioning that narrative into, diversifying the capital pools for the Indian impact investing sector as a whole. So personally, for me also, this has been a very, very enriching journey. And I would like to thank all of you for that as well. So this sets the stage perfectly for our opening plenary for today, which is Risk, Return, and Impact, the tripod of impact investing, where we not only look at the journey of some of the funds who have been, been there in this journey since the very start, who have witnessed complete fund life cycles, and we'll also look and talk about how impact investing as a whole has been trying to balance the tightrope between, commercial returns, risks, and social impact. So before we commence the conversation, I'd like to extend our gratitude to Omidyar Network India for their gracious support towards Prabhav 24. So we have with us a stellar lineup of speakers who together have pioneered impact investing in India and who've also been the strong proponents of IIC since the very beginning. So it gives me great pleasure to invite on stage Geeta Goyal, Managing Director, India, Michael and Susan Dell Foundation; Sandeep Faryas, Founder and Managing Partner, Alivar Equity, and Co-Founder, NMAS; Sugandhi Matta, Chief Impact Officer, ABC Impact; Shilpa Kumar, Partner, Omidyar Network India, and Executive Council Member, IIC. And moderating this conversation will be Royston Briganza, CEO, Grameen Impact Investments India, and co-chair of IIC. So on that note, over to you, Royston.
How do you see us having performed thus far?
I think the final score in the end. But I would say there has
Is the mic audible? I can only hear myself quite loud. She needs to be louder, right? Higher, faster, louder?
All of the above, okay. So yeah, the first few years of impact investing, I think there was a lot of experimentation, passion, failures, innovations, successes, till we all felt, let's get together, let's create this Impact Investors Council, let's, push the ball forward. And I think, we heard the numbers, $30 billion, the market has evolved. Not only, I would say, impact enterprises and impact investors, the external market around us has also gone a significant change. Which is all good, more capital coming in, more entrepreneurs coming in, more impact happening, more scale, more efficiency, all positive. I do think we've reached a point where we should really say what is impact investing now. I remember in the early years, we used to talk about intentionality, low income, and now when more and more capital, the likes of Temasek are also coming into this space, it's worth defining what is impact, and are these, are there sectoral investments? Are we doing affordable consumer tech? Are we doing affordable fintech? And now environment is also there. So it's intentionality. So in my view, I think we've reached a very good juncture for us to really say now to drive this forward, now to drive more innovation. Because I think if we stop the innovation engine, then we will be where we are. So yeah, we're at a very good point in our journey, if I can say that.
Thanks so much, Geeta. I think you've added one more eye to Prachi's three eyes. You talked about innovation. And that's something that maybe we'll come back to you and double click on what innovations you've seen in this sector. But maybe turning to you, Shilpa, and I should have started with the birthday girl, but then I'm sure we'll embarrass you enough right through the day. But as someone who's been really so passionate about impact investing, and again, one of the founding members of IIC, you had a certain vision when you started, when Owen started in India. If you look at that roadmap, as we're picturing this first round as a marathon, how do you see the journey thus far?
So our journey actually began in a sense with a blog which our founder, Pierre Omidyar, published. It was a very simple idea that technology and entrepreneurs can solve the world's most difficult problem. And that idea was in itself, so simple but so powerful. And to see where that has landed is amazing, because I think the idea is that can you really go to underserved communities, can you go to underserved markets or sectors, and do work through sustainable, profitable business models. I think we learned a lot. I mean, I just want to take 2 minutes to look back at this 10-year journey. And I think one of the first learnings was, look, just investing in these enterprises is not enough. Can you invest in infrastructure beyond ecosystem, beyond these enterprises itself? That was the first. The second was technology in itself is not enough. Maybe in certain frontier markets you need hybrid markets, you need to think about other ways of reaching these communities. The third was very interestingly that returns is a continuum. There is no such thing as, this is the return to target. It's more like what's the trade-off you want and what's the conscious choice you and your investors want to make. And the fourth one, which, like Geeta said, is very much work in progress, is what is impact? And, unfortunately, social impact is not an easy to measure thing. And, just building out the strands of what is impact and how we should measure it, I think it's still very much work in progress that we all need to think about. But if I look at the broad 10-year message, it's like, look, the model works. There's no question. The model works. We can deliver significant returns. I think that's also true. Our companies can scale and you can have mainstream investors come. Some of these companies go to IPO. That's also true. So I think a lot of very interesting things have come out of that one simple idea. But to me, Royston, this year for me was bookended by two 10-year celebrations. The first one was in Jan, a company of ours, in fact a common investee, iMerit, celebrated 10 years. It was a very small seed check we had given them. And the celebration was on a football field-sized ground. All the employees of the company were there. And these are young women and men who do data annotation for driverless cars, one of the use cases, in some of the leading companies in US. There were about 5,000 of them in that field. The confidence, the energy, the feeling of having moved, was so dramatic. We all came away very, very energized and believing that what we were doing actually has significant outcomes. I think the second 10-year celebration is what Prachi and Ranjana both alluded to, is 10 years of IIC. And I think one of the most catalytic checks Omidyar ever wrote was really in a sense, the seed of founder member check for IIC, and we continue to be proud charter members today. I think that one check to have transformed into, in a sense, this whole ecosystem, this community of people all interested in deploying significant amounts of capital raised across India and the globe, I think to me is really a sign that we've come a long way.
Awesome. Thank you so much for that. Sugandhi, they both talked about giving checks at the start of the first 10 years. Girish is waiting for the next 10 years. It may not be such a small check, but now that Thamasek has come to the party, maybe one of the things that Geeta alluded to is, the entry people like Thamasek sort of reinforces the way the world is looking at impact, and within that, looking at India in impact. From the lens that you sit in from Singapore, we're seeing a huge amount of focus now on Asia and impact. and within that India sort of stands out as a great example. Maybe you could give us, in some ways, I would like to say an outsider's perspective looking in, but now that you're in, what are the key things that you see as spectacular?
No, thanks, Royston. Happy to do that. Good morning. For people who don't know me, and also because you've brought up Temasek, maybe I'll spend a few minutes just introducing our fund. And
Is the volume okay on her mic? A little louder, please.
I'll just spend a few minutes talking about who we are, what we do, and why I would say I'm an insider, but I'm okay to live with Royston's outsider perspective. So ABC Impact, we're an impact equity fund. We invest in social and climate or environmental impact. The sectors that we focus are on financial services and climate. Our AUM is about $800 million. We're investing out of our second fund. 1/3 of the funds have been invested in India. We also invest in Southeast Asia and China. So in that sense, I am part of an organization which does have a pan-Asian lens to impact. There's a few messages around this question that I'd like to share with this audience. One is around, I think Geeta, you alluded to, what is impact investment? I think we spend a lot of time, I feel sometimes, tying ourselves up knots. But when we are selling the fund or when we are pitching this opportunity to international LPs, I think the risk-return question is where people spend a lot of time. And one of the learnings in the last 2 years has been that impact portfolios are much more resilient than standard private equity funds. And I think that's something that we've been able to demonstrate with our portfolio, and we know a number of peers are same privileged position. So I think there's a lot of focus on returns, there's a lot of focus on what's competitive returns, what's market rate returns, but enough time also needs to be spent on the risk and the resilience of an impact-focused portfolio. So that's, I think, one of the things that international LPs do focus on, and that's one of the messages I'd like to leave with you guys. The second point from an international perspective is that India is in a very, very privileged position. There is tremendous track record, demonstrable success, stalwarts like Eliver, Omidyar, who've sort of really paved the way for impact investing, and it's really made it a very fertile ground for bigger funds like us to be able to build on that success. So India is very unique and very privileged. We have the advantages of innovation, scaling. That's the key success factors for most impact businesses, innovation and being able to scale. And finally, I'll say that, as we hire people, I think this industry, this movement, this ability to deploy capital in a purposeful way, it does attract a lot of talent, not only for ourselves, but for our portfolio companies. So I think that's another aspect of this mission that we don't spend enough time thinking about. Maybe I'll pause there and happy to double click on anything.
Thanks so much. That's a great perspective. Sandeep, when I look at you, Duplantis comes to mind. Duplantis is the guy who which your era would talk about, Bubka. The one who pole vaulted and sort of bettered his own record repeatedly and sort of benchmarked against himself. Elevar has been that type of an entity in India to really excel and then further surprise people by excelling even further. And you've been at that helm of that journey. So if you look at your pole vaulting history, what has really challenged you to challenge yourself? Would have been those highlights of that journey?
Good morning, everyone, and thanks, Royston, for the comment on my looks.
I thought I made that up with...
No, I completely agree with you. What I'm surprised about is you didn't call me old, because while we're all celebrating...
you by Pupka.
Yeah, while we're all celebrating 10 years, it's actually 20 years since I entered the impact investing space, so that was 2004. I think in those days we didn't even call it that. I think the language evolved since then. Well, I don't know, are you calling this like building on things? I think we should probably have a more honest conversation. It's time to put the platitudes to the side and really have an honest conversation. So let me make a few points. I think there have been tremendous successes and I think we can list them all out. I think the microfinance journey in India, the financial inclusion journey in India has been just incredible. The kind of capital, and the presentation earlier talks about the whole sector, just incredible again, the amount of capital, and we need a lot more. But if you ask me, I don't think this sector is keeping pace with the pace that the customer is going through. That transition over the last 20 years within an Indian context has just been stunning. We used to use language like bottom of the pyramid. Today, we're talking about resilience, we're talking about aspirations, we're talking about where their wallet is being spent, and an understanding of that which is way beyond just, let me increase your income by 10% by giving you a loan. Now, where is the capital which is aligned to be able to build those kinds of institutions, I think is an open question. Alignment is difficult despite large pools of capital emerging within the space. So I think that's one thing that we should all keep in mind. And I want to be also clear, I'm not actually making a comment of saying, oh my God, there's a problem. I'm actually making a comment about, oh my God, here's the opportunity. So I want to be very clear about that. The second point that I think we need to really recognize is that my belief after 20 years is that there is still a fundamental bias against this customer segment that exists within the world of capital. It is the hardest job to pitch a company within this space to broader pools of capital still. I don't think that's changed. That battle of ensuring that multiple pools of capital to scale up companies remains a challenge. It should have become easier with all the track record that has been built. And I view that as a fundamental bias issue. There is a disbelief that that customer can pay for a quality, affordable product or service, and that disbelief needs to fundamentally change. The third point for now I will make is, and I think I completely agree with Geeta, that we really need to push the engine on innovation. Because of what we innovated 10 years ago, what we innovated 20 years ago, is now part of a growth journey. That's done. The question is, what are we going to innovate on now? Given that the pace of innovation and resilience at the customer level is going through a much faster change, I think is the call for action and the wake-up call for the sector on an overall basis. Now, you talk about successes and failures. Sure, I mean, I'd like to believe we have more successes than failures, and we've had many failures. But I think the constant battle every day is that aligned capital search. Because I think the impact investing space actually does not value its own work. Who are the people who pay the lowest valuations for companies? It's actually people within the impact investing space. Why don't we value our own investments better? I don't have a clear answer on that question. And if we need to actually go out and actually attract pools of capital from the mainstream which are significantly larger, why don't we actually become momentum investors which are willing to pay the right valuations for the kind of impact that has been created on the ground, beyond just looking at conventional financial metrics, to be able to then tell the world that actually real impact and real returns, risk-adjusted returns, have been created. I'll stop there for now.
No, that's excellent, and the fact that you're segueing into something that we wanted to do in the second round itself. And so, Geeta, coming straight to this point that Sandeep made about the need to crowd in more pools of capital. And I think that is something that we are seeing. When I spoke at the General Assembly, that number was $30 trillion for the SDG cap. Post-COVID, that is now $37 trillion. Next week at the General Assembly, it's likely that SDG target itself, the goalpost, may shift to 2040. There is a desperate amount of raising $40 trillion. It's not going to come from, philanthropy or donor money. And yet, from the perch that you sit at, how do you see this philanthropy or donor money being able to drive new pools of capital in? Maybe you can talk to the blended finance story a little more, but just give us a window into how do you see these new pools coming in?
Sure. And I would just address some of the biases that Sandeep referred to. I think there's a bias on the customer. I also think there's a bias on impact. Yes, for
just
10
want to do a
years.
sound check on that mic.
So, yeah, I do think there's a bias on the word impact. I mean, for 10 years we've been discussing risk return, successes, and yet impact capital comes with, a slight perception issue. And that's where I'm thinking, like, if we rebrand it to say, like, these guys know affordable fintech, these guys know the customer, And so this is the affordable customer category. So these are specialized funds which know the customer. The reason I'm bringing this up is I think seeing the momentum on impact investing and serving this customer, several other funds have also come in which are not impact funds. They may have blown up a lot of money trying to service the customer, but it was just not serviced right, or they did not get as much share of the wallet. And then it becomes, oh, this customer is not serviceable. But I think a lot of us who work with this customer pool know it's serviceable. There are many other services that can be given, but you need to do it the right way, at the right pace, at the right price. So yes, I think the biases exist, and as philanthropy, as Impact Investors Council, what can we do to actually try and remove the biases and keep the journey going forward? So I think examples of success are important. Larger pools of capital are needed. They will only come when we share success stories of growth, and there are enough. And I think, Sugandhi, you mentioned India is at a great stage. We genuinely are. So there are. So I would say building out success stories, giving the risk capital to build out these success stories is where philanthropic capital can come in. Philanthropic capital is needed to test out some of the blended finance models. We've been, just as a precursor, the foundation has been in India since 2006. We've invested over $350 million. We do grants and we do equity, debt and guarantees. Over the years, I think it's a 50-50 split. We realized that scale does come when you invest in companies and enable them to grow. So, and in that course, I would say, I also agree we've had fewer failures than successes. So I think if you invest right, you get it right. But we are also now seeing the need to blend different pools of capital. Not in terms of Series A comes from impact and Series B comes from commercial capital, but to say in the beginning, can we have like a guarantee pool from an impact capital? Can we have outcomes linked financing? So we guarantee, and I think Gates used these instruments quite well when they guaranteed volume contracts on some of the vaccines. So we've also been venturing into outcomes linked financing in education, in livelihoods. We're trying to do guarantees. And this capital will not come from commercial capital. But once you've done a microcredit pool that's guaranteed at 10%, then 5%, no losses, the third pool will go on its own. And I think it gives us the opportunity to also blend in government capital. And I think maximum success does come in when government policy, market and the philanthropic work comes together. So I would just say early stage capital, more risk capital, clear attempt at leveraging other pools of capital from the very beginning and not as a after effect. But all of this only comes if there are if you have credibility to have seen success. So I think those success models are important. It only comes if you have some focus and therefore some knowledge or information on a sector. Like tomorrow, if we start something in healthcare, I don't think we will be able to leverage other capital. So I think going deeper, taking higher risks, consciously bringing in other pools of capital, including government capital and DFI capital, which wasn't as much a part of what we did initially. And I think, IIC definitely also has a role to play, and at the India Blended Finance Collaborative does that.
Excellent. Shilpa, one of the sort of thrusts we're seeing right now is a lot of money coming in for technology. I think that is one area that global pools of capital are really excited about. India is in some ways one of the leading countries for technology. How do you see it from Omidya's perch in terms of AI and sort of blockchain and other new tools of technology that are coming into the impact sector? Do we need to recast some of the offerings? Do we need to pitch differently to be able to bring those pools of capital into the impact investing space? Are we missing a trick in terms of crowding in that type of capital? I know you have your own sort of committed funding source, but a lot of funds in the room, are going in for their second fund, third fund, and those are the LPs that they are looking at money from. But something's missing. We're not able to see those huge amount of pools of capital come into impact. So what has Omidya done in terms of technology, and how can we attract more to the sector?
So I think technology is a really interesting question, because why is it so important in what we do, I guess, is really it has the ability to change equations relating to, affordability, access, ease, choice, convenience. But when we look back again, before we look forward, I mean, it clearly seems like one of the big reasons for success in India has been that there are, digital rails which have really helped entrepreneurs build on top of them. And these digital rails, typically, if they are either funded by philanthropy or by government, or regulatory bodies, in a sense lay the pipes on which people can innovate at very low price points. And just seeing how that has kind of played out in many areas, it seems like it's a good way to go forward. But the two cautions I just want to kind of bring into this discussion is that even as we look at technology as a big solver, I think the fact that, especially for the customer that we care about, is it staying sufficiently inclusive? Or are there layers that you need to add on top of it? I think those really become important. I think the other one is really just on, the whole, is it empowering enough? Is it safe enough? Because, and I think CrowdStrike was a great example, right? I mean, there's so many things we suddenly go digital about, but when there's a risk, what does it mean for the entire, gamut of customers you serve? And therefore, how do you balance the fact that technology can solve many things, but at the same time, layer it with, okay, is it secure enough? Is it safe enough? Is it responsible enough? I think that balance will stay very, very important, even as we think about technology as a great enabler.
Thanks, Sugandhi. I in fact was in Oxford last week on the Outcomes Accelerator program and the conference on outcomes. Measurement of outcomes, pay for performance models, these are, the honest one in the vein of Sandeep was that people there said, we thought this would have been much bigger 4 years ago when those first outcome bonds were launched, SIBs, DIBs, whatever the nomenclature. The feeling in the room there was something has gone wrong. We've not been able to scale, we've not raised the trillions, forget the trillions, we've not even raised the billions in the scale that we need. Something is not right in the way blended finance, outcomes based. Is it what we are measuring? Is it how we are measuring? Is it the credibility of the measurement? Is it that we thought people will invest because of outcomes, but they're purely commercial, which Sandeep will answer next? What is it that we are not getting right in the outcome space?
That's a very tough question. I think from our perspective, I would agree that I think everybody thought this blended finance space, outcome space would be much bigger. I think my hypothesis on what's difficult, and we've seen this with our portfolio companies, so maybe three things. One is the resources required to do these outcome measurements are intense, and that's not just money. I think money is almost the easiest thing to solve for. But the effort from our portfolio companies, the kind of time that you need to do, long-term tracking, I think it's pretty complicated, and I think people underestimate how much effort that takes from the portfolio companies, their customers, the patients, So that's one point. The second is, what is the question we're trying to answer? Again, to put a fundraising lens, when we go and fundraise, what are the questions people are asking us about outcomes? Are they willing to dig deeper? Are
There's
they
some
willing
door open somewhere. There seems to be some noise. Can someone check, please?
Are they willing, sorry, I was just saying that, when LPs look at our outcomes, what are the questions they're asking? Are they willing to let us double click into investing more time and effort with a portfolio company? The third thing on outcomes, I would say, is that, we recently did a very detailed study with our portfolio companies, and there was a few things that came out of it. Our companies spend a lot of time on ecosystem building. So if you look at a healthcare at home, which is an out-of-hospital care provider, transition care provider, they are working to set standards in this industry. They are working to educate customers about this industry. So there's a lot of time spent on ecosystem building, which is where I think philanthropic money or blended finance can actually play a huge role, and that can enhance outcomes. So I think that's been one learning, focusing on ecosystem building. My last point is less about your question and more about maybe a reflection in the room, right? I think when you look at outcomes, there is that analogy of the elephant and the 7 blind people, each one of which looking at different parts of the elephant and trying to figure out, is it a rope, is it a wall? I think we don't help ourselves, honestly. I think the participants in this room, we don't help ourselves. We all talk sometimes different languages. We all hold each other up to different sets of standards on outcome measurement. So I think that's one thing where we're kind of all holding ourselves back, right? Because if we all just align and say these are the 3 ways we're going to do it, these are the 3 ways we're going to measure impact, then I think the conversation and the journey will be a lot faster. And finally, going back to something that Sandeep raised, right? I think we have to ask people to look at underserved differently. I think that time has passed where if you're in a tier 3 city or a rural city, you're underserved. If you're below an income level of something, you're underserved. So I think that's another way where a new lens is needed, and that impacts outcomes. Because when people ask me how much percentage of underserved one of my portfolio companies has reached, they're only thinking about a poor person. But if you're thinking about a bright student in a tier 3 city in India, can't access the best teachers, Vedanta is providing access to the best teachers. That person is underserved. So I think going back to outcomes, it is about looking at things differently. Let's all help ourselves and not kind of disagree with each other. I think if this was IVCA conference, we wouldn't be spending so much time. We'd be like, here's the sector, here's where the deals are. So I think there is something about our industry also where we kind of, we are prone to too much introspection.
Are we schizophrenic, Sandeep? Is that our problem? Because, in some ways you're the only one on this panel, other than me in some minor form, who's looking outside for capital. This captive capital, in Temasek is okay.
I would like to disagree with the panel coordinator here. We are a third-party backed fund. Temasek is obviously one of our key investors and huge supporters.
Right.
Also an investor in Elevar. But we are asking for third-party capital. We are out there fundraising. I think we are facing a lot, and we are, pan-Asian.
So then, are you finding that as a challenge? Are you
It
finding
is.
our the impact lens that we put on it? Is that a constraint to us raising
No.
commercial capital, or is that a plus?
I think it's a positive, but I think we need to be aligned in how we sell it, and we don't make it that this is the hunting ground and we're only hunting in this small part of it. Which is again going back to what Sandeep said, that we need to reframe the conversation for those people. Because if you have 100 opportunities and as impact funds we're only going to do 20, obviously they're not going to.
So how do you frame that elephant? I mean, which part of the elephant? Does each one pick their own part of the elephant, Sandeep?
I think we need to recognize that this is not 7 people looking at an elephant. This is a lot more than that, right? Almost all the language, and I think Sugandhi and Geeta referring to the fact that we need a brand articulation which is different about this customer segment, and you talking about the fact that multiple people take different approaches, and we need some degree of alignment. Our approach at the North Star consistently, since we started off in the early 2000s, has been that we will be completely customer-centric. We will reject any top-down articulation or sizing of market or any consideration. The worst thing somebody on my team can do on an investment memo is saying McKinsey said this is the size of the market. I'll be like, go down to the field and please tell me what is the reality from there. Our North Star today, and this is after some introspection through the COVID years, because we thought there would be a decimation on the portfolio through COVID years. That was the sense in the first month. And then there was amazing resilience that was seen on the ground. Not only did the customer not get completely destroyed, they actually started to demonstrate resilience and move in a different direction. So I think we have to acknowledge that, and I think we have to learn from that. So if we have to be genuinely bottom up, I think there are few things that we need to keep in mind, and we are making that attempt. One is, we need to re-articulate who this customer is. Now, when I say resilience, let's recognize there's an entrepreneurial spirit out there. Now, people will say, no, they're looking for jobs. Sure, they're looking for jobs. But if you look at the household, and we think of the household as a unit, there is always more than one income. There are multiple sources of income inside the household which are bringing a tremendous degree of resilience, some of which are informal in nature. Now, by very definition, that is entrepreneurial nature, an entrepreneurial household, if you will. Number two is, I don't think we appreciate the transactional volume that is taking place just on core solutions as far as this customer segment is concerned. We did some work, we put out a report also last year. In 2023 alone, if you just take transactions, now people will say GDP is bigger, or smaller, all of those things. Just every dimension of transaction of a household within Indian context, this is a multi-trillion opportunity. From an investment standpoint, you can come into the input on the transaction, you can come in on the output on the transaction to be able to drive incomes as far as the household is concerned. So if you think about that, that's just a stunning number. And we have to appreciate that they are already transacting. We can only accelerate in terms of approach. That's number two. So what are we doing? We're saying we're going to create 50 plus, somewhere between 50 to 100 blue chip companies. I think what is blue chip, we can sit and debate. But we're not going to say 200, and we're not going to say 400 or 1,000 companies. We're actually going to focus our energies. It's all about transformational platforms. Today, I think we have an opportunity to think about companies that can transform an individual space quite fundamentally. We don't need to take slivers at the problem because we have the technology, we have the capability to look at data on the ground, we have the talent that's coming into the space to be able to think of some companies as platforms that can scale and truly transform. And that will be our focus fundamentally. So if you ask the commercial dimension, which was kind of like, the commercial opportunity is very simple. The technology world did a phenomenal job of classifying technology companies as something unique. Only a few of them are genuinely technology companies in a true sense. Most of them are actually enablers. We are using technology in our portfolio. Everybody on this panel, many people out here are using technology. I think we need to recognize that building companies focused on this customer segment requires a different kind of DNA. That DNA of company building, it takes a different approach to build for this customer. And that approach, if we're going to focus on, the way we think about talent, the way we think about technology, the way we think about data, the way we think about brand and marketing will completely change. How many brands are we aware of in the impact investing space that are ubiquitous in the space today? Why haven't we spent time on brands? I think we need to change our mindset in terms of thinking about these platforms and how they're going to add value to the customer. So customer-centric transformational platforms should be the goal for everyone else.
That's fascinating. I think what sort of comes back to mind is microfinance. In some ways, that sort of demonstrated the ability and the brands and some of the names you looked at. One of the key things there that drove microfinance, and some of you are early investors in MFIs, but from the Grameen lens, was the access to debt. The fact that priority sector lending by the RBI was able to unlock huge pools of capital. And we're not seeing that move even on this panel, and again, I hope Sugandhi doesn't correct me, but most of the money that the four of you have brought in has been equity. And therefore, there is, I think, a fundamental warp in the way we've looked at impact investing and not looked adequately at impact debt. And there are other panels coming up. I mean, Grameen's own innovation has been micro bonds, but it's been terribly small. If we need to bring in for a $15 billion, 3x multiple leverage of debt to equity, at least we're looking at $45 billion that we need to have of debt. We have no visibility of that right now. So how do you see that unlocking?
I think that's a great point. So let me give you stats from our portfolio, just to give it. So we've raised...
And then we start ramping up. So just your last closing comments, keep that in mind. And then we can...
So we've raised something around about through our 5 funds, about 450 plus million kind of concern. So let's say we're investing 80% of that fundamentally, the rest is operations, right? The equity leverage, the way I would calculate it, which is how much of co-investor capital has come into our companies as a multiple of our capital. And keep in mind, we're almost invariably the first source of capital. is something like 8 to 10 times. You take the amount of debt that's come into these companies, now leverage at any point of time is appropriate. The total amount of debt is an actually further multiple on that, which is very, very significant. So probably another 5 to 8 times of that number. That is a considerable amount of money which has come into less than 30, 35 companies as far as India is concerned in our portfolio out here. So it's a highly concentrated approach. But you're absolutely right. We have to think about capital in all its forms to be able to drive
Systemically.
Systemically. We have not used debt adequately. We have not used MES as adequately. None of those mechanisms. And if you look at the successful companies, few and far between, really, if you think about it. I'd like to believe I have more in my portfolio, sure, to an earlier point. But having said that, those are the companies who do well in terms of thinking about the multiple sources of capital. They will tend to raise from both commercial and impact sources. They will not be only impact sources, and that's how they will scale, because they are actually very flexible, agile, and nimble to be able to raise multiple kinds of capital. You're absolutely right on that one.
So those from IIC who are taking notes, and hopefully the next elected members are sitting in this audience. But I think the point Geeta makes about innovation, the point technology, the point that Sugandhi is making on impact, definition, measurement, the point Sandeep's making on brand building, and the point that I'm making on debt. I think that sort of, if we can get that together in the next 12 months, that's the biggest gift we can give ourselves as a sector for our 10th anniversary. The focus on putting these key blocks in place to be able to then unlock the $1 trillion that we need to for the SDGs. So if there's any burning question from the audience, we have about 4 minutes left, so you'll be eating into their 1 minute summaries. But if there's something that's, we can take a mic there and we'll just take one question since everyone else took time to put their hand up. If there's a way to get a mic to the gentleman who's on the table next to that big light. Yeah, go for it.
Hello. Thanks. I guess this question is...
You'll introduce yourself first.
Sure. I'm Abhishek Damani with Quilvest Capital Partners. We're a global fund of fund. I think this question is more targeted towards Geeta and Shilpa. If you look at your history of equity investing versus grants, and if to be honest to yourself, where has more of the impact been created through yours? Is it through equity investments or grants? And number two, sorry, quick question to that is one of the other models that focus on for-profit investing and use those cash flows towards grants, is that a more effective way of creating impact?
And maybe you can also weave your closing comments after the answer.
Okay. So yes, I think it's very difficult to compare the impact on grants versus investments. We also do some grants where we piggyback on government dollars. And so I think where the scale comes from, if you ask me that question, it does come from the government and from the market. But I do think grants have played a very important role in helping us understand the customer. I think Sandeep was smart enough, they got to the customer without the grants. We actually did go through a grant cycle to just understand more about the customer, what works, what doesn't, what creates more impact. And I do think even on the microfinance side, I mean, we could, like all of us could invest in it because there was 10 or 15 years of grant capital which helped prove out the Grameen model. So they just play different roles. I mean, our returns go back into our endowment, and therefore it can, again be reinvested as investments or as grants. But there are definitely a lot of funds, including, SIF, where some of the returns from the equity investments, and they may not be impact equity investments, they go back and get recycled as grants. I mean, I would say it's like a CSR type of a contribution. You can decide whether you want to do 10, 20, but I mean, both of them in the course of a market making do have an important role to play.
I think it's really hard to answer the question about which has been more impactful, because both are extremely impactful in their own ways. Like grants actually make the soil fertile in a sense sometimes for then market entrepreneurs to come in and plant the seed of sustainable businesses. And you can't measure one without measuring the other. To my mind, as a sector evolves, as momentum builds, you have less and less need for grants and more need for sustainable capital into which mainstream capital can also come. But it's a much longer and very interesting conversation. Happy to take it in the break offline.
And you want to weave any closing comment and Shilpa?
Yeah. So, I would say this was such a fascinating discussion because I think we were looking back 10 years, also looking ahead. To me, the essence of what we are saying is, look, we're a community of people who think about capital and our human capital in a sense, in a very catalytic way. We are like, which are the communities which are still underserved? Which are the sectors which are still underserved? How can we go in there, look for impact, look for returns, and when, in a sense, momentum builds and mainstream capital rushes in, we can go elsewhere and do that all over again. And I think the discussion we had right now is like the last 10 years has been great, but for the next 10 years to be similarly catalytic and for us to celebrate such growth 10 years later, do we need to take a step back and rethink a few things? And I absolutely agree with that, and I'm sure the next 2 days will unpack that.
Neither has some closing comment.
Maybe I'll just use a quote from our founder. He says, ideas are a commodity, but execution is not. And I think especially when we are working with this customer segment, if we don't focus on execution, given the lower margins. So I think that's been a guiding principle both for our grants and investments. The reason I bring it up here is in the context of IIC and impact investing. As we think of this sector to scale up and pivot, gather more momentum, I think we need to focus on execution, which means simplify things, less jargons, less silos. I really second the point that Sugandhi made. Let's keep it simple and let's make it similar. Let's not create buckets within us. But most importantly, let's craft a narrative which is more appealing and doesn't show biases for this segment.
Super, because the fourth one that was added to the faster, higher, stronger was together. And, that's been, pretty powerful. Thanks for bringing that in. Sugandhi, your closing comments.
No, I think this has been a fascinating discussion. You can also see the spectrum of opinions given our different backgrounds and how we came to this space. I think my two key things are optimism. I think I'm very excited about India. I think India has all the ingredients for impact. I think we just need to crowd in more capital stacks and work together to do that. The second point is I think we should invite contrarian viewpoints into these kind of community discussions a bit more. I think we all want to make the tent wider. We want to mainstream this asset class. We want to bring in a whole bunch of more capital. So I think it's good to also bring in external viewpoints that are not part of the movement.
Super. Mr. Contrarian himself, last closing comments.
Well, let me pick up on that question of grant versus, I think it's a false dichotomy and I want to end on that. The biggest commercial success in the impact investing world has been microfinance, and I think we forget that it stood on the shoulders of non-profit microfinance for 30 years before it could build out into a commercial journey. The big challenge as we go forward is consistently we have to find a way not to view the customer from a top-down lens. We have to go by what the customer articulates to be impact. So for me, it is going to be, today we have the capability to go direct to be able to assess that, not through conventional research methods and research methodology, etc. I think there are data models that we can build where the customer can articulate how we want to think about impact. The customer can articulate where they want the service to be delivered, at what price, and can we build business models based on that. That is the challenge of the day. I don't think we should be thinking the way we've thought about over the last 10 to 20 years. It requires a completely different mindset. Some of us will become bandicoots. Let's be very clear in what's going to come in the next 20 years. Because the customer is going to move at a pace that we will not be relevant as individuals or as organizations. And thank God for that. So,
awesome. Now that's a great way to look forward to the next 10 years. Thank you to my fellow panelists. The slide at the back shows us our hair color after 10 years. Maybe 10 years from now, we'll have the same slide with the new hair color. and new faces to those blank faces behind us. So thank you. Let's remember faster, higher, stronger, and together.